Welcome to this class, and I'm going to do something which is so interesting, and that is known as disposable income, aggregates of disposable income. So disposable income is made up of factor incomes plus non-factor income, so which is, in other words, the transfer incomes. So we know what are transfer incomes. We've studied it earlier. It is a unilateral payment as against the factor incomes, which is for a service rendered. So I want you to just go through this. Look at this. So while you look at it, I'm just going to explain to you that. So of course we know that national income is a measure of factor incomes accruing to the residents of a country, and factor incomes flow from production activity. But we know there are certain incomes which do not flow from production activity, such as donations, charities, taxes. And these are known as non-factor incomes. Now, the sum of factor incomes and non-factor income is called disposable income. So we are going to talk about disposable income aggregates. So there are many aggregates woven around disposable income. And talking about non-factor incomes, they are made up mostly of transfer incomes. So it's important to just revise a little about transfer incomes. So what are they? So what are transfer incomes? So transfer incomes are a transaction in which the payers provide a good or service or an asset without receiving from the recipient any good, service or asset in return. So that's a transfer. So in brief, any payment made without getting any good or service in return is a transfer payment. It is a payment without any quid pro quo. Let's take a gift. The payer makes payment in the form of money or goods or services but does not receive anything in return. This is a transfer payment. Now all transfer payments are kept out of national income. So this we have to keep in mind when we're estimating national income. So transfer incomes are made up of current transfers and capital transfers. So what are current transfers? A transfer made out of current income of the payer and added to the current income of the recipient. And these transfers are within a country or between two countries. For example, now for this, within a country could be tax, scholarships, unemployment allowances, old age, pensions, etc. And between countries, they can be say donations and say during natural calamities, etc. Now capital transfers, what are they? A transfer made out of wealth or capital of the payer and gets added to the wealth or capital of the recipient is called a capital transfer. For example, within a country, if you are considering capital transfers, they are like capital grants or lump sum payments to household affected by natural calamities or accidents, payment of taxes on capital and wealth, etc. So between countries, if you're taking, they are like war damages, international grants such as that, or any major natural calamity. But just to remember once again that while making estimates of national income, we don't consider this current as well as capital, none of these. But when you're doing, at the same time, just to remember to make a note, when we are doing disposable income, only current transfers are considered while estimating the disposable income. So let's talk about national disposable income. So there are two aggregates to this also. One is known as gross national disposable income, GNDI. It is a sum of factor incomes and non-factor incomes. That is transfer incomes, gross of consumption of fixed capital accruing to the residents of a country. So It is like, for example, GNDI is equal to GNPMP plus net current transfers from abroad. Just remember, market prices is always there with at market price, not at factor cost. And then let's take NNDI. It is defined as a sum of factor income and non-factor incomes, net of consumption of fixed capital accruing to the residents of a country. So then it happens, it is equal to NNPMP plus net current transfers from abroad. Or if you have GNDI, how do you derive NNDI? From GNDI, when you minus consumption of fixed capital, you get net national disposable income. So this was what is known as the government sector. So now we are going to do the private sector. So now we're going to do the sorry, just see NNDI and GNDI. I didn't turn the page for you. So just make sure that you're able to see this clearly. And once again, so this is in the government sector. In fact, it's for the entire country, but now we will do the private. In the private sector, disposable income aggregates. We're going to do disposable income aggregates in the private sector. That is important. So again, we have around net domestic product at factor cost accruing to the private sector. Then we'll have accruing private income, personal income, and personal disposable income. 4 of these. So 4 of these aggregates we should know just as a general knowledge, because I don't think this is in your syllabus right now, but still it's important for general understanding, and that's why I'm doing it. So you can just go through this. So let's take what is NDP accruing to the private sector. So in this, I'm going to focus our attention on disposable income aggregates of the private sector. And in this, first we'll find out, it is necessary to find out net domestic product at factor cost accruing only to the private sector. And for this, what do they do? So in this, we know that they are in the domestic factor income, they are income from property and entrepreneurship which accrues to government department, administrative departments, and savings on non-departmental enterprises of the government. So this has to be deducted to get income from domestic product accruing to the private sector. So out of this, we'll take out which is accruing to the government sector. So we have, like, for example, earlier we studied that the government sector units are broadly classified into producers of government services, that is general government, departmental enterprises, non-departmental enterprises. So by deducting income accruing to these sectors, these units from NDPFC, we get NDPFC accruing to the private sector. So sometimes it is also referred to as, in India, income from property and entrepreneurship accruing to the government administrative departments, including that accruing to departmental enterprises, and savings, that is undistributed profits of non-departmental enterprises. So this has to be taken away. So if you take this out from NDPFC, what you get is income from domestic product accruing to the private sector. Then we have what is known as a private income. Then private income is what? It is a sum of factor incomes and non-factor incomes accruing to the private production units and households before payment of direct taxes. So private income is equal to income from net domestic product accruing to the private sector plus net factor income from abroad. And then you have national debt interest, and you have current transfers from government and net current transfers from the rest of the world. So if you take net incomes from domestic product accruing to the private sector and net factor income from abroad, these are factor incomes, and the rest are non-factor incomes. And interestingly, I want to just discuss what is national debt interest. What is national debt interest after all? See, just little let's dwell on this for a little while. So national debt interest is when the government borrows either to combat inflation or to finance important unavoidable expenditure. The borrowing is unproductive. So interest is paid on such borrowings to those who have subscribed to the national debt. Hence, the net interest paid up by the government plus the interest paid up by the consumers must be added to national income to arrive at estimate of personal income. So in short, it comes under what is known as a transfer income. So then we have what is known as the private income. Private income we finish. Now we're going to do personal income. So what is personal income? So now talking about personal income is what is see, private income belongs to both private enterprises and households, and personal income relates only to households. Households are the owners of private enterprises, but in business, separate entities of owners and enterprises is maintained in the matter of keeping accounts. Income first originates in the enterprises, who in turn disburse this income to their owners, but the entire income is not disbursed. A part of the entire enterprise's income goes to the government by way of corporate income tax. Another part may be retained within the enterprise and not actually distributed to the owners. This part is termed as undistributed profits or retained income, or simply savings. So when you deduct these two from private income, we get what is known as personal disposable income. So we've written the formula too. So you can understand with that private income, when you minus retained earnings of the private corporate sector, that is net of retained earnings of foreign companies, and minus corporate tax, that becomes personal income. And now we come to personal disposable income. So personal disposable income is what? It is personal disposable income is from the personal income when you minus direct taxes paid by households and miscellaneous receipts of government and administrative departments. So what are the direct taxes paid by households? They are like income tax, education tax, sanitation tax, etc. And miscellaneous receipts are what? Like compulsory fees and fines, etc. collected by the government from the household. So in other words, personal disposable income is a sum of factor and non-factor incomes of households after payment of direct taxes. And another thing, sometimes personal disposable income can also be seen as, when you have your disposable income, what do? You either consume or you save. So with that, we come to an end of what is known as disposable income of the government sector and the private sector. So we'll get back to say either numericals, or I'm going to start unit 2, that is money and banking.